On the podcast with us today is James Kandasamy. James, welcome to the podcast.
Hey, happy to be here, Dan. Thanks for having me here.
Well, James, I want you to get us started and give us a little bit of a background about yourself and what your current focus is right now in the multifamily space.
I'm from Austin, Texas. Currently, we own like 1,400 units with asset under management as an operator about $100 million. And we have across 8 properties and focusing a lot in San Antonio and Austin area. We started multifamily 4 years ago in 2015, and we started from single family houses, doing rentals on single family houses in 2013, and we grew to multifamily in 2015, and this is where we are right now.
Great. No, go ahead.
I'm just saying that background as electrical engineer, worked in corporate life for 22 years, have an MBA, love multifamily right now.
Yeah, that's great. And what's the property that well, I know we're going to talk a little bit about a book that you just recently had launch, and we'll talk a little bit about that towards the end. So for those of you who are listening, make sure you stay towards the end to hear a little bit about that. But I want you to talk to us a little bit about the high level specifics of the deal we're going to be going over today.
Yeah, we're going to go over a deal called Boston Woods Apartment. That's my second deal. That we bought in 2016, right?
It's called Boston Woods.
Boston Woods Apartment, yes.
Okay, and how many units is that one?
That's basically 174 units. It consists of 3 different properties, and we bought the deal directly from the seller using our yellow letter marketing or seller to. Marketing directly to seller, and we're able to refinance that deal within 12 months, pulling out almost $5 million in cash out.
What percentage was that of the initial capital?
117%.
Oh, wow. 170%.
Yeah.
And how many months?
12 months. So
12.
In 12 months. Yeah. And we refi and we keep that property until now with cash flow of almost like 7% cash on cash return annually. It's basically on an infinite return right now to my investors. But that's how much we're paying. The 7% is based on original capital that we put in.
Okay. And how did you find this seller? Because I know you said it was direct to seller, so we're not talking about brokers here, but what were you doing as far as the marketing to be able to get access to this seller?
This was using our yellow letter marketing and also our text blasting. So we were able to compile the owner's list and send out an email, send out a text or email, mail or text to sellers, and one of the sellers responded, and it took almost a year to negotiate that deal, because usually when you go direct to sellers, they are not in the mind of selling, right? So it's different from deals that you get from brokers. They already at the point of selling, whereas when you go direct to sellers, they may not be selling at that point of time, right? May not be urgency. So yeah, go ahead.
What was the purchase price on this one?
That is what we bought it at $6.9 million purchase price. We did put in $1.5 million of rehab. It was appraised as at almost $13 million in 12 months.
Wow.
It's crazy, right?
Yeah, that's phenomenal.
Yeah.
That's a great value add. To buy it for 6.9, take 12 months to implement the $1.5 million capex, and then to be able to have it refinanced and appraised for 13 million is in 12 months. That's phenomenal.
Yeah. I think even we didn't pull out all the money that's able to pull out, just because the banks are usually very scared when you don't have any money left in the deal, right? There's no cost basis, so they're very, very scared. But we have to do a lot of presentation to the bank to convince that this is not a market appreciation refi. This is a real value at refi, right? And there was a lot more meat on the bone for the deal.
Mm-hmm.
The bank was comfortable.
So one of the questions that, I get quite a
Mhm,
bit about, trying to find deals
mhm.
is, when you start to get over 100 units, it's very hard to find a deal over 100 units that's direct to seller. And so how do you get over that mindset? And are you only looking at over 100 units? Or are you kind of doing like a mix of some of the lower end ones as well, as far as a smaller number of units? This was kind of just like an anomaly.
I would say above 200 units is where you start hitting to that roadblocks, not 100 units, unless, yeah, 200 units and above is where you hit roadblock where, the sellers are a bit more sophisticated. They want to go to brokers, and even, less than 200, 200 to 100 or 100 to 200, you'll find sellers um, who may sell to you directly without brokers, right? I mean, it's all a numbers game, right? The more funnel you open, you may find that, the 1% of people who want to sell, but usually there are the best deals out there, right? Then you buy from brokers.
So when you first reached out to this seller,
Mhm.
you sent them a couple of letters in the mail, various things like that. Did you make phone calls to them, or did they just reach out to you after getting one of your letters, or how did that first initial contact work?
They got one of my texts. In fact, not the seller directly, but one of the seller's relative got it. Or seller's partner, I would say, right? And that person say, hey, this person may sell this to you, right? So that's how we got the lead. And we started following up on the lead and talking to them. And they are not mom and pop. These are big brokers, but they are they are not in multifamily. They are in land business. Multifamily is so sexy nowadays. A lot of people want to try out multifamily from different business, and this is one of cases with them. They were always doing land, and they said, let's try multifamily because it can make more money. Then later they realized actually the headache of property management is so huge. You can't just give it to third party, right? Because now you have to be an active asset manager as well,
Yeah.
right? So they realized their mistake, and they said, we love land, we want to get out of this, right? So, and they had a partnership issue with the partners themselves. And, one partner want to sell, one partner didn't want to sell. Good thing is the partner who want to sell was talking to me, right? So
That's a good start.
yeah, good start. He was trying to convince the partner who doesn't want to sell. Um, and at the same time, the partner who didn't want to sell is also having a controlling stake. But it's a complex relationship between the partners there. But it took 1 year for me to convince them to continue selling, and I'm the right buyer for the deal.
Yeah.
And they did sell to me at market cap rate. So market cap rate was 6.5%, and I did buy it at 6.5%. It's just that it's 6.5% with another 3 or 4% of upside cap rate, right? So we bought it at market cap rate, which nowadays is impossible, right? Nobody want to sell you at market rates anymore. People just want to sell you slightly above market cap rate, even though that's value add.
So when you were doing your underwriting on this one, what was your exit cap projections if you bought it at a 6.5?
So when I was underwriting this, I didn't really look at exit cap rate. I know there's so much of upside on this deal. I was buying it at market cap rate, and I know in 2 years I can take it to almost like 8 to 9% cap rate. And I said, okay, that's good enough. And the cash flow was huge once I fix it. So that's two things I only looked at. I looked at cap rate at that point of time. I mean, now, because that was my second deal. Now after my third and fourth deal, I start looking at entire investment cycle, which is including exit cap rate, but not for the first few, because I was just looking at cash flow year on year basis and how much upside do I have in that deal.
Mm-hmm. And as far as the financing on this one, did you start out with a local lender, or did you go with a bridge lender, or how did you work there?
So we had an option to go on a bridge or conventional bank loan, or I could have assumed the loan. So I did a lot of analysis. What should I do? Right? If I assume the loan, it's a Freddie Mac loan with a 4 year left on it, but I have to pay like 500,000 of penalty if I refinance it in the next 1 to 2 years, right? If I do a bank loan, I don't have penalty, but I also have 500,000 more in terms of price. So the way I negotiated with the seller is basically add that penalty into the price, right? So it's higher price, but I have penalty, or I do go and assume the loan with the Freddie Mac assumption, but I get a lower price. So after my calculation, both came out to be the same. So I said, to be safe, just go and do a Freddie Mac loan assumption, I get it at a $500,000 less, which I paid when I refinanced. But that it really doesn't matter to me because we were making like $5 million. The 500,000 really doesn't matter at that point of time.
Mm-hmm. And when you were doing your initial underwriting on this, did you project on your returns that you were going to be able to get more of your equity out on that refi?
Well, I know myself, but I just didn't tell my investors because you always want to try to over deliver, right? So even the cash on cash itself was awesome already. I did give some hints that we're going to refi in a few years, but I didn't tell how fast we can refi because until you take over property, you just wouldn't know how much work is it, what is hidden there, and it's a risk, right? Especially when you do a deep value add like this one, right?
Yeah.
It's a lot of risk. So I mean, my investors trusted me with our skills, and we're able to over deliver.
How many offers or rounds of offers did you go through? Because I know you mentioned it taking a year. So how many of those back and forth did you actually have to come up with the purchase price?
It was twice, I think. See, the one problem that we had was because we are talking direct to seller, right? And seller was trying to figure out what's the price they should sell, and they want to get out as well. So it's just chicken and egg situation. So I'd say, I'm just going to give you guys the price because I was waiting like 6 months, 8 months, nobody wanted to come up with the price, right? So I said, hey, let me give you guys at like $37, I can't remember. And then after 1 week, they said, yeah, actually your price is almost similar to what we want. Okay, I was so happy. So only twice we did going back and forth. And they came back with, 1,000 per door more, that's it. And I said, okay, fine. And that kind of deal would have been easily 20,000 per door more on a real market if I come to a broker. So just because I know that I'm already getting a good deal, and I just keep my mouth shut and went ahead with putting it under contract.
Yeah, as soon as you can when they say yes, right?
Exactly. So yeah, it was direct. It was just good deal.
At what point did you actually tour the property?
I toured the property when they first told me, and when I said, wow, this property is really distressed, but it's really beautiful. It's a very pretty apartment, but it's distressed. It's just deferred maintenance. Nobody take care of it. So immediately when they told me, 1 year before when they might sell this, I went and toured it.
How many people are working on site on this property?
On site, 4.
Okay.
174 units. So I would say that's the most we can afford.
Yeah, that's about right.
Yeah.
So you have a full-time property manager, leasing agent, maintenance supervisor, and a maintenance tech.
Yeah. Yep. Correct.
Okay.
And this property won the property of the year for San Antonio for 2018.
Wow.
Yeah. It is very fulfilling because my wife and I put in a lot of work into the deal. And it took us like 8 months to almost turn around the property. It went down from 90% when we bought it. Of course, they have bad tenants, right? So much after 10, 12 years of same management and third-party management, which never really cared. The occupancy dropped from 90% to almost 75% in the next 2 months, right? So we have to quickly remodel things and quickly turn around. So it almost took us like 6 months to bring it back to 90%, right? And 8 months to really stabilize. And on the 12th month, we started refi.
So did you project that in your underwriting, or was that kind of like a, after the fact thing that you guys had to deal with?
Well, that was the second deal that we did. It's a bit hard for us to predict how we're going to turn around this kind of property. But we did tell our investors it's going to take like 8 months to 12 months for us to pay out, right? So, but we did beat that expectation. So we did inform our investors that's going to take some time to pay out, but it's a really good deep value add that we're doing.
So when did you give your first distribution on this one?
1 year and on the 15th month, right? So after I do the refi, that was the first distribution.
Oh, wow. So that was a nice distribution for those investors.
Yeah, yeah, exactly. So my investors, so out of 117%, I took almost 17% for rehab, almost $400,000 to $500,000 of rehab. I just kept it aside because we almost out of rehab money at that point of time because we were going so fast and we're turning around a huge property turnaround. And we gave back our investors almost 90% of their money back after the compensation to us to like almost like 10%. So then I think what we did was we kept on giving out quarterly cash flow, like 7% annually right now to our investors.
I mean, that's still phenomenal, man. That's
Yeah,
just
which is like what, 70% cash on cash?
yeah.
With a 10% return. Now they only have like 3% left in the money in the deal for investors. So by this year they're almost running on infinite for their returns. But
Yeah.
it's a crazy return deal. I wouldn't even use awesome. It's like crazy. And a lot of my investors keep on asking for the same deal. Actually, our first 3 deals, we are almost doing the same, right? First one, we almost pulled out 170%. It was a small 45 units. Second one, we did this Boston Woods. And the third one, we're almost pulling out like 75% out. It's actually closing in 1 week. It's actually closing in 2 days.
The refinances?
Yeah, correct.
We need to get you on to talk about that one too. Get you on another podcast here.
Yeah, it's we have a lot of case studies we can talk about. That's the third deal is very interesting as well. That's very creative. But we'll talk in the next podcast possibly.
Sure. Well, I know the listeners will be interested in that too, because obviously these deals are what motivate people to actually take action and do something. Because a lot of times we sit on the sidelines and you miss deals like this. But for you to be able to go in there, start marketing to these owners, and get them to be a point of wanting to sell to you, and then being able to return that kind of capital is just phenomenal.
Yeah, correct. I mean, if I already return all the money back to my investors, and we are actually basically just having a free money coming in from a building, right? So where you can get that kind of investment.
Oh yeah, I mean, and those investors that you do that with continue to come back more and more and more. Correct. When that happens.
Correct. Yeah, I mean, after the 3 deals that we did, where we did a lot of deep value add. I mean, the past 5 deals we are doing more stabilized deals. I mean, not to say stabilized, it's a light value add. It's a value add deal, but it's not a huge deep value add anymore. And we do a long-term loan from day one itself, just because the market's a peak and we want to be more safe. But the experience and skills that we learn in the first 3 deals, it makes it easier for us to run the easier deals nowadays.
Mm-hmm. So did you, in this process, did you have to, when you're going back and forth in your offers, did you have to put up any earnest money? And if so, how much was that? And at what point did it go hard?
Well, I mean, this is what, 3 years ago. I mean, I'm talking direct to the seller. There's no day one hard money and all that. So we had like 3 weeks of feasibility, or maybe 1 month of feasibility. We have all the terms, belong to us, because we're talking direct to the sellers, and the sellers really want to sell. So we had like almost 1 month feasibility, and we had like 70 days to close, and we had a lot of, I think I put like 1%, the normal earnest money. Yeah. Compared to the deals I'm doing right now, it's like I have to do like day one hard money, right?
Yep.
Even though it's a bit smaller amount in my submarket compared to like Dallas and all that.
Yeah, no, I think right now in the market, right now we're recording this in February 2019. A lot of these deals, they're to be competitive on them, you have to put that hard money up day one. And I don't know if say you have to. I mean, we actually just lost a deal recently where we were putting up 200 hard day one on a property, and somebody else, the person who got it, outbid us by over $500,000. They were number one, we were number 2 in the price, but they went with them and they had no hard money.
Okay. Wow. Really?
Yeah.
But just because of the price. Okay.
It was because of the price. They had $500,000 more than we did, but no hard money. But we had $500,000 less. And even though we were in the second position, now we might get it on the rebound, which is fine with me. I'd love to have that property still. But it gets a little frustrating sometimes when you don't really know for sure. And I think that's probably makes it harder on the sellers too, to decide, who should I actually, award the deal to,
Yeah. I think part of it is, I mean, for me is because my first 3 deals, I went direct to the seller. Actually, my first 2 deals, I went direct to the seller. The third one, it came to a broker, but still was more of a distressed situation. But because I'm talking direct to the seller, right? But recent deals has been through brokers, even though I'm a local player, they know me pretty well. But I think in general, brokers are making it competitive, right? Because they want to show to the sellers that they are doing a good job. At the same time, they do not want deals to fall through halfway, right? And so that's why they want the hard money and all that, right? So, but that's what it is, right? The game we play.
So as far as the $1.5 million CapEx, what were some of the things that you did during those renovations?
I think we spent almost 600,000 on exterior, where we did the painting, we did the landscaping, carpentry work. That was almost 600,000, and there's another, the remaining money, like around 900,000, is all of the interiors, where we did new flooring, two-tone color. We also had a stainless steel appliances. So we were like, because we know we bought the deal so cheap, we were like really using all that capex, all the rehab money, capex money, to push our rents to the highest. Even now, it's still not the highest, but still we are trying to push it really, really high so that we can refinance it. So we pushed our value as much as possible by doing all this, crown molding, stainless steel, and all that. Even though recently we changed to black appliances because we already refied and done, right? So we were doing a lot on the interiors.
So stainless appliances. Did you do new cabinets?
No, we didn't do new cabinets. We have never done new cabinets until now, because cabinets are really, really expensive. The worst case, we just paint them. We did crown molding, and we did new fixtures, new toilets. A lot of, because this property, as I said, it was in a distressed situation for past 10 years. Nobody really took care of it.
Did you do new flooring?
New flooring, yes.
Okay.
We changed everything to vinyl.
Okay. Did you do new counters?
New counters, yes. Depends, right? If it's really bad, we'll change our counters. Otherwise, we'll just resurface it.
Did you do just a standard, replacing it with a standard countertop, or did you do like granite?
No, standard one. So this submarket doesn't need a granite flooring. I mean, not flooring, countertops or kitchen.
Granite flooring would be nice, though.
Awesome. Yeah, I used to have that in my house in overseas.
Well, we actually just took over a property that the leasing office had. I guess it used to have tile throughout. It doesn't now. It has carpet, but they have a radiating heater throughout the entire flooring system.
Really?
And with a boiler attached to it and everything.
Wow, must be in a cold place.
It's really not. It's not really that cold. But I think the property, it used to be a house, and they converted the house to a leasing office and then built the apartment around it. And so it was kind of already built into us. They just probably didn't want to move it. Yeah,
got it. Yeah, I used to have, I came from Malaysia originally, and a lot of people have granite flooring over there, because granite is, the Malaysian granite it's one of the best quality, and it's cheap over there, but not in the US.
Yeah. No, it's not cheap because we have to get it from Malaysia.
Yeah, it's far away, right? Yeah.
So let me ask you, how did you structure the deal with your investors?
So I do a simple structure. I don't do pref returns. I do a 80-20 split on all profits. And I do return back their capital either at sale or through a refi, 100%. Then on top of that is where we take the profit. Otherwise, it's 80-20 profit splits.
So it's just a straight 80-20. And then, so when you did the refi and returned 20% or we had 90% return to the investors, you also got part of that return to you from that 20%.
Correct. Yeah. Total investor return was almost 100%. I think on that deal, I only took like 10% because that was my first deal. I want to make sure I do a good job. So that was like almost 90-10 split, right? So now after that, it's all 80-20 right now.
Okay. All right. And how did you find these investors, and how did you raise the capital for this deal?
Investors is basically referral. When you give this kind of returns, there's going to be a lot of referral coming in from friends and families and relatives and all that, right? So it's basically an organic growth. But I also do a lot of webinars for my investors, just free. I publicize in Bigger Pockets and through my social media. Just free webinars, and that's where I started building a relationship with them, and just giving value to investors, and the word gets out, and especially if you have a good track record, a lot of people knows that you know what you're talking about, right?
So you said you were doing webinars. How did you get people to the webinar?
Bigger Pockets, social media, email, and just getting people to just subscribe to my email. My website has a funnel where people can come and register, and from there, you just publicize to them. We're doing a webinar on, let's say, a tax webinar for passives, or let's say, um, what are the webinars? Asset protection webinars, and all. I mean, you do a good job on webinars too. That's really good. So that's what I was doing in the beginning.
I learned it from you. Knows what it was.
Thanks for the compliment.
So your spin on the webinars was more on, passive investor topics.
Correct. Yeah, my webinar is all passive investors because that's the only thing I need right now, right? So, I was focusing a lot on passive investors now. How do you get tax benefit? How does passive investors have asset protection? I mean, people talk about asset protection, right? There's a lot of webinars on asset protection, but they talk about all for the active investors, right? So I said, let's do an asset protection for passive investors. They may not be, but they may be questions on, hey, can I do an LLC? Can I do this? Can I invest through a trust? So people come to that webinar and start building that that trust, and I'm just the host, right? I mean, I do ask someone two questions to these experts who are coming and presenting, but me bringing in that experts and coming and giving webinar is just another resource, right? So that's where I grew my passive investors list.
And how do you typically structure the syndication? Is it a 506B or C?
I usually do 506B. I only did 506C once, and I realized it's not very effective. Usually people who want to invest with you, you need to have some kind of relationship. Otherwise, it's going to be very difficult to raise money from them, right? I mean, not everybody want to give money to someone you do not know, right? So no matter how famous you are. So I do usually 506B, and I take some time to establish a relationship. So whenever people come and register on my website and all that, I'll make sure I have a call with them. I get to know them, and after that, through emails, and they attend my webinars, they're on my list and all that. So that's how I build my relationship.
When you did the 506C, what kind of issues did you have? Was it more on the line of you didn't really get as many more investors that you thought you might get because you could now publicly advertise it? Or is it more of the, did you have issues with the investors not wanting to verify that they were actually accredited?
I think the issue with 506C first is it's a bit hard for us to go to a stranger and ask them money, right? Even though you do advertisement. The other thing, a lot of people didn't like 506C because now they have to do all this paperwork, right? And a lot of my investors are so used to 506B. I mean, 506C is a new thing, right? It's like starting from 2015, right, with the Jobs Act, right? So my investors are seasoned investors. They have been investing before this with some other people, and they've never done this kind of paperwork, and they feel like it's so much work to invest with me, and a lot of people didn't like it. And people say you can go and get a CPA to verify and all that, but a lot of them went to CPA, and there's so much question. A lot of CPA do not want to verify them because they say it's liability. So there's so much issues on verification of the accreditation status, right? I mean, we did use that verifyinvestor.com, which was pretty good, but a lot of people didn't want to share their financial statement, upload to some random websites too, right? So which is a lot of people don't trust the internet, right? So we had a lot of issues. People do not want to go through the paperwork. When I say you can go to CPA, a lot of CPA didn't want to do it. So I know in theory 506C sounds cool, but I think a lot of people just didn't like it, especially if they've done 506B, right?
Did you have what is your typical minimum investment in your projects?
50,000.
Okay, so even when you did the 506C, it was still 50?
Yeah, correct. I did my 506C on my third deal. It was 50,000, and even people want to come up with 300,000. I usually tell them to, because I do not know them, I usually want to establish a relationship. Sometimes I tell them to, just bring in 50,000 because it was a smaller deal, and I want to establish a relationship. And the reason why I put 50,000 is so that I can continue build my investor base too, right? So what's the point of getting 200,000 from one person versus 50,000 from 4%, right? So you establish a relationship with 4% rather than 1%, right? It's a bit more paperwork, but it's okay for long term.
So when you did the 506C, what were some things that you did to publicly advertise it? Because that's really the main advantage, is being able to publicly advertise.
Yeah, I tried some Facebook ads, but maybe I didn't really push very hard on the advertising at that time, right? Because I was just trying out 506C, right? And but I was able to send mail to people that I know little, or I can talk to people, a lot of people out of my networking group, right? So I didn't do very well in advertising. That's something I would admit. But still, even though you advertise on Facebook, someone call you, you do not know who's the person, they do not know you. It's a lot of convincing, right? And I really don't have to do it when I have a good base of, investors they already know that able to give me the money that I want for my deals, right? Unless I'm buying deals every month, I'm buying like huge deals, like $13 million. Then my investor base will dry out of the money. Then I need to go and use some other people to help me raise money as well, which 506C becomes very critical, I guess, at that time.
Have you ever considered doing a fund?
No, I usually do specific property deals because if I find a good deals, I can raise the money very quickly within 2-3 weeks, right? So it's all about the deal nowadays. I mean, now market's it's at a peak. There's so much capital, right? Why do you want to do a fund? I have considered a fund. I did thought about it, but not to buy deals right now. I may get a fund to buy deals during the downturn, right? So, but for now, I don't see a reason to do a fund because there's a lot of capital out there chasing for this good deal. So the idea is to get a good deal, then the money will come.
Yeah. Good. Did you find any issues that came up during the entire process of this specific deal, Boston Woods, that we're talking about, whether it be in the due diligence process or anything else?
Oh, there's a lot of deals coming. A lot of issues came up with the property. This was like a 10-year distressed property. One of the issues we realized is the foundation issue. So we did bring in a foundation company to come and do inspection, and they gave me a bid for like what, 300,000 to repair it, right? So I was, oh my God, that's gonna break the budget, right? So we did try to go back to the seller, but seller was giving me a lot of hard time. I mean, they were giving me a hard time. They were asking me for more money, and which was okay. They were asking me for more earnest money, and I was like thinking, but I did hire an independent engineer, which cut down the overall cost to like almost like 120,000. So that was a good decision that that listeners can take away, because don't go to a barber shop and ask them whether you want a haircut or not, because they're going to say yes. You definitely need a haircut, right?
Yeah.
So now I'm always get a third-party independent people who are not tied to that job, like an independent engineer to do an inspection on a foundation issue. Right now, I always do that so that they can give me an independent assessment of the deal rather than thinking that, I want to get the job later on.
So I have two last questions that I want to ask you, but before I do that, I want to jump back to the raising capital piece. How much capital did you raise on Boston Woods?
Boston Woods was 3.76 million.
3.76. And how long did it take you to raise that money?
24 hours.
Wow, that quick.
Yeah, correct.
That's awesome. That's
because
great.
It was an awesome deal.
So how did you present it to investors? Was it just you calling people, or did you do a webinar, or how did you do it?
No, I did a webinar. So I make sure that all my deals have a very, very detailed analysis of the deal, including the submarket and all that. So I did a really, really detailed webinar with my investors. A lot of people knows that it was an awesome deal. So people came with big money coming in, and I presented the deal to them.
And how many investors do you have in that deal?
In that deal, probably around 40 investors.
40?
Yeah.
Okay. I couldn't tell if it was 40 or 14. So, so 40.
No, 40.
Okay.
Yeah.
Okay.
Yeah.
That's great. I mean, James, this is a phenomenal deal. I mean, you did a great job on this thing. I mean, kudos to you. I want to give you a big old, good clap right now just to tell you on this. This is a phenomenal deal. But I do have two last questions. So first question is, what did you find easy during this entire process on this particular deal that you thought might be a little bit harder?
Oh, I mean, everything was hard in this deal.
Fair enough.
Everything was hard. I mean, we did $1.5 million in 12 months, right? So at the end of 12 months, I was wondering, how did I spend $1.5 million in 12 months? I mean, it's a lot of work, right? So we had a lot of vendors that working on the property from day one, right? So and after the overall, as I said, at the end of 12 months, we become really an expert in how do we manage contractors, how do we get bids, how do we monitor their work, and
Did you raise the 1.5 or did you have that on the as a draw from the loan?
No, I raised it.
Okay, that makes it much
Yeah,
easier when you're doing renovations.
absolutely. Yeah, that's a good point because this was a loan assumption, right? When I took over,
Yeah,
so I can assume only the base, so that everything was raised. Um, yeah, everything was hard about the deal,
yeah.
but
So
but
that was
we
gonna be my
came out
last
very strong.
question. My last question to you is going to be about what did you find was harder than you expected during the entire process? So, what was one thing that was so hard that you just thought, man, it should be a lot easier than this?
Now, that's a really good question. I'm thinking, as I say, everything was hard. The tenant demographic changed. The tenants was in a really, the selection criteria was really out. So we have to like replace a lot of tenants. As I say, we went from 90% to almost 75% and came back up. You know, the selection of contractors, right? So usually we try to take like 2, 3 contractors to do the work and then see who's the best, and then we fire the other two and get that one guy to do the rest of it. So that was a good thing we learned on how do we select contractors because in the beginning when you start you do not know who's doing very well, right? And contractors is one of the hardest to manage when we are managing and keep in mind, I don't know whether I mentioned this or not, we own everything. We own asset management, we own property management, and we own construction management, right? Even though the construction management we use subcontractors, they don't work as a W2 to us, but we manage the entire pipeline. So that was another strong point that we had in our company. Um, and the other one I just want to make sure I mention is, me and my wife work hand in hand. I mean, she takes care of the rehab and property management. I do the acquisition and underwriting. So she did a lot of work to turn around the property,
Don't
right?
leave
So
her out now, James.
yeah. I need to mention that.
Well, tell us about your book.
So my book is on Amazon right now. It's called Passive Investing in Commercial Real Estate: Insider Secrets to Financial Independence. So this book was written specifically for the majority of the real estate investors in deals that we usually do, syndicated commercial real estate, right? So passive investors, are basically, how do they find the deal? How do they find the deal sponsor? How do they consider deals, right? There's a lot of people doing deals, right? But how do you choose which one is the best for them, right? What's their risk profile? What's their investment profile? Where do they invest? Which asset class do they invest? Which cities do they want to invest with, right? Because if you look at it from passive investors, they have a lot more option on where they want to invest, right? Whereas apartment syndicators like us, we need to focus on one asset class because there's a lot of details in the asset class that a sponsor need to know. Whereas passive investor, they need to know the sponsor. They need to know what the sponsor's doing, right? The sponsor background. Where do they raise what's the money raising process? How do they promote themselves as a passive investors, right? What are the different types of capital sources that they can use? What are the pro and cons using IRA, using QRP, using cash? What's the pro and con, right? How do they have a gut feel check with the sponsor, right? Where they are in the investment cycle. Do they do a deep value add deal? Do they do a core plus deal, which is basically a cash flowing deal? So these are the things that I covered in my book. We have awesome reviews right now. We have almost like 15 5-star reviews right now, and a lot of them are seasoned, multifamily passive investors. And if the seasoned guys are telling that they're learning a lot of things from the book, I would say even the new people would be able to learn a lot of things from that book. So it's $3.99 right now. Go and get it. I can bet you it offers you a lot of money, a lot of value compared to a lot of programs out there that may cost you 10 to 20,000.
And we can get that book on Amazon, right?
Yeah, you can go now and get it from Amazon. Look for passive investing in commercial real estate.
Well, I'm going to do that myself and now, and I'm going to go make a review for you as well to help you out there.
Awesome.
For those of you who are listening, you want to get it. That's called Passive Investing. And what's the rest of the title?
Passive Investing in Commercial Real Estate: Insider Secrets to Financial Independence.
Awesome. Well, we'll make sure that we put that in the show notes and give that link to everybody as well so they can go straight there and purchase that book. Well, James, I want to thank you so much for taking some time to be with us here today. You've been great. You've been awesome. Looking forward to having you on another episode as we dive into one of your other deals.
Awesome. I'll be happy to do that. Thanks, Dan, for having me here.
Thank you.